These days, always in the news headlines, there is a mention about bond yields and why the world is worried about a rising bond yield. In the next few minutes, we'll try to understand what the real bond problem is, with yield curve inversion, rising yields, and how it can impact the stock markets in general. At the beginning of the month, traders in the future markets were betting that the interest rate would be about 4.2%, but now they are betting on a rate of 4.8% by the year end. While the central banks held its main interest rate in the range of 5.25 to 5.5, projections by its policymaker is signaling towards one more rate hike. Now, what is all this? And how can it affect the equity market? And economists are saying that this might affect the equity market, and the equity markets can see a sell off about 40 to 50%. And some economists are going out of their way and saying like a 80% crash in the stock market. Now, we really have to understand what this bond yield problem is. Losses of treasury bond with maturities of 10 years are now down by 46% since March 2020. And the 30-year bond is now down by 53%. This is unprecedented selling in the treasury bonds. And this was last seen in 2008. Those losses were nearly in line with the stock market losses seen during the worst crash when equities market slumped 49% during the dot-com bubble and 57% in the aftermath of 2008. So the current bond crisis, the bond sell-off, is equivalent to the crash of the stock market in the 2008 and 1999. And that's interesting. Compared with the previous bond market meltdowns, long-term treasuries are seeing one of the most extreme selling in history. And the losses are twice as big as those seen in 1981 in the 10-year yields. Long duration yields have climbed to their highest since 2007, with the 30-year note passing the 5% barrier. So what does all that mean? Does that mean the bond sell-off is actually triggering a sell-off in US equities like it did in 2008? Will the stock market crash and we see prices of stocks coming down by 60% or 70%? So by the end of this video, we'll come to understand what really this sell-off means, what the rising yield means, and what a yield curve inversion is. So all those technical jargons will make it clear in this video. Now, well-known investors like the heavyweights like Bill Ackman, Ray Dalio, and Bill Gross, they say that the 10-year could hit 5% in the near term, and that will be the highest ever in the past 40 years. To understand all this, we have to understand what really is a bond and what is a bond yield and how does the bond yield talk so much about the future of the economy and how it can predict the stock markets. At the end of this video, we will come to understand how a bond market can trigger a sell-off in the equities market. And we are not talking about like 5 to 10% downside here. It could be a huge downside. It could be like a 40 to 50% downside in the equities market. So before we do that, we'll try to understand the basics of a bond market. So what is a bond? A bond is a loan made by an investor to a borrower for a set period of time in return for regular payments. The government issues a bond to the investor, and the investor in turn gives $1 billion to the government. So a bond is issued by the government, the investors buys the bond and give $1 billion to the government. Now the government can use it for for infrastructure development or for fulfilling the other liabilities which the government has. Now, the time from when the bond is issued to when the borrower has agreed to pay the loan, it is called term to maturity. The main difference between a bond and a regular loan is what we need to understand. A bond can be traded by the investors in the securities market. A loan cannot be traded. So what's happening here is these investors actually trade the bond with these guys. And that's why the original value of the bonds do not remain same, and they change because now the market forces have come into play. So now when you buy and sell some security in the securities market, there's a demand and supply which is going to come into force. And that's why there is a price fluctuation in the price of the bond. And and similarly, there is a fluctuation in the yield of the bond. So we see clearly over here, the government issues a bond which is purchased by the investor worth $1 billion, and the, the bonds are traded by the investors with other investors in the secondary market. So when they issue, they buy it in the primary market. When they trade it, they trade it in the secondary market. And because of this demand and supply, which is happening in the secondary market, the price of the bond and the yield of the bond keeps changing. That's why it's not static. And that's the difference between a loan, a static loan, and a bond loan. Now, the most important question is, what is a bond yield? If you want to see it in simple terms, a bond yield is the return an investor expects to receive each year over its term of maturity. So, a simple definition of it is expressed as a percentage of bondholders' return, I mean the annual rate of return on a bond, and divided by the bondholders' invested capital. So let's say if the annual rate of return on a bond is $100 and the bondholder has invested $1,000, the bond yield is 10%. That's simple calculation. So current yield, if you want to calculate the current yield, it's the annual coupon payment. That the coupon payment is the interest payment which the buyer gets, the buyer of the bond gets, divided by the bond price. What's the current bond price? So that's simple mathematics. If if you want to calculate the current yield, annual coupon payment divided by the bond price. So let's say initially what happens is the annual coupon payment is $100 and the bond price is $1,000. So you get the current yield as 10%. Now let's take another example. The US government bond yield is 3%. What does that mean? The issuer of the bond is the government, the US government. The buyer of the bond is a common investor. He buys the bond and he seeks 3% returns on this bond. Now, when a bond is issued, an investor has purchased the bond for the first time. That's called a primary market, which we saw earlier. But later on, that bond will keep trading in the secondary market, and hence price and yield may change. Now, we also have to understand the buyer gets 3% on the bond, but the issuer now has a liability of 3% to give to the buyer every year. And this is how, when the bond is given to the buyer, the bond is issued to the buyer, the government becomes liable to pay 3% to the buyer. Now, with all this, what we have understood what a bond is and what a bond yield is, this is the most important relationship, the relationship between the price of a bond and its yield. Let's check out. Now, this might be tricky to understand, but the whole of this video depends upon your understanding of this important concept. Price and yield are inversely related. This means as the price of the bond goes down, the yield goes up. And conversely, as the yield goes down, as the yield goes up, the price of the bond goes down. So if an investor purchases a bond with a face value of 1,000 and he has a coupon of 10%, the cash he derives is $100. Now let's say that the government increases the interest rate by 2%. Now what happens? Now this bond will be still giving a 10% coupon. So how will the new buyers come into this bond? They would say that, okay, the current interest rate is 12%, but the coupon is 10% over here. So why do I buy this? So what happens is the bond price goes down. It goes down to 980 so that it can compensate for the 2% increase in the yield. So what is happening here is the initial contract specification of the bond doesn't change. It's just the price goes down so that it can compensate for the extra 2% which the new bond is giving. So if I'm confusing you a lot, just don't worry about this part. Just keep in mind that the bond yields, when they go down, the bond prices go up. And the bond yields, when they go up, the bond prices go down. Another simple example to understand. Now let's say a bond is interest earned is $5 and the current price is $100. So what would be the current yield? It's simple, 5 divided by 100, that's 5%. In the bond B, the interest earned annually is $5, but the current price is $500. The current yield therefore becomes 1%. It's simple mathematics. Now, with this, what you have to understand is if the price of the bond goes up, the yield goes down, and vice versa. Now, this simple explanation will make you understand what really is the relation between the price and the yield of a bond. Okay, let's come back to the real scenario. Here the US bond yields are rising from 0.2% in 2020 and it has now reached 4.64%. That's a tremendous increase. And if you see in the past 6 months, this is a chart for the past 6 months of the treasury yields, and you see where it was like 2.9% and it has increased to 4.6, which is there on the chart. Now, after the pandemic, the government's easy money started to flow in the wake of near zero interest rate. And the rate is not sustainable now because we have a bigger issue which is coming in, and that's the inflation. And hence the government has to increase the interest rate to tame the inflation. Mind you, the inflation target is 2%, but right now we are at 3.6% as per September inflation report. So what has happened? Why did the yields come up so much? So what has happened is there is a big sell-off in the bond market. And the sell-off means high yields, as we have seen earlier. Why is this sell-off coming in? Because the time for easy money has gone down. And people are looking for other avenues and dumping the US bonds. And that's the reason why the price of the bond keeps going down. And when the price goes down, it has to compensate with the yield. The rising of the yield is not just a market phenomena, it is indicating something, and we'll try to understand what it's indicating exactly. So what happens when we have a rising bond yield? Since early August, America's 10-year treasury yield has traded in excess of 4%, a level which was seen in 2008. And up till 2021, it has not come up to that level. On October 3rd, 2023, it hit a 16-year high of 4.8%. Now, what has happened? The moves have spilled over globally, and Europe's bonds have also started to increase their yields. It's now threatening a financial crisis for a lot of companies like Italy and Japan as well, which is clinging on rock bottom interest rates. And the problem with these countries is they cannot really increase their interest rate. That's the biggest thing. Because if they increase their interest rate, there could be corporate bankruptcies, and not one or two, maybe like a nice 10% bigger companies can go bankrupt in Japan and Italy. Well, that was one part of the problem. To understand the second part of the problem, this is a very important concept which we need to understand. What is a yield curve? Now, when I take all the bonds with different maturities and I take their yield, so this is the yield of the bond, these are the yields of the bonds, and these are the maturities. And if I plot this graph on x versus y axis, I get a curve, and this curve is called as the yield curve. What it means is that when I see the 1-year bond, the yield is lesser than the 3-year bond, and so on and so forth. So the longer term bonds have larger yield, a bigger yield, compared to the 1-year or 3-year bonds. This is a normal curve. I mean, this is how the bond yield curve should look like. A normal yield curve often indicates a bull market. It often indicates that the problems of the economy are over and the economy can now take a new boom run, and the economic growth and inflation are increasing, but in a proper manner. Now, let's look at the other two types of curves which are more threatening to the world economy right now. So we saw this normal curve where all the yields are increasingly step by step according to the maturities. But look at the second one, it's a flat curve, which means now the normal long-term curve has changed, and the yields for all the years have become almost similar. I mean, it cannot be exact, but it's very close, and that's why you get a flat curve. Now, The problem is the third one, the inverted yield curve. Now, this becomes a problem because the long-term maturities are showing less yield than the short-term maturities, which means a one-year bond has a higher yield compared to a 30-year-old bond. Now, how is that a problem? Now, just imagine what is this saying to the about the general investor. The general investor thinks that the long term the yields will be down, and when are the yields down? When the price of the bond is higher, which means they are expecting a rate cut in the future. When the rate is cut, the yields will go down and the price of the bond will go up. That's simple. We saw that earlier. Now, when the 30-year-old bond shows lesser maturity, which means the investor is thinking that going ahead, there has to be a rate cut. And, and when does a rate cut actually happen? So when is it possible that the interest rate will be lower than today? That happens in the case when the markets believe that there could be a recession or severe economic slowdown. In that case, the central banks will lower the interest rate because they want to stimulate the economy, and no government wants to look at recession for a longer time. And this belief, the belief is that in the future, the economic condition of the country might deteriorate. In other words, there could be a recession. And what happens in a recession? The government is forced to lower the interest rate. So, so now we understand what a yield curve means and what the yield curve says about the market. Now, this investor perception keeps on changing. It's never fixed. But what has happened is we are into an inverted yield curve in the United States bond market for the past 18 months now. And if you see the history, the yield curve inversion has never gone fail. A recession has always followed an inverted yield curve. Now let's look at the real scenario. The US Treasury yield curve with 1 month, 2 month, 1 year, 2 year till 30 years maturity is in front of you. And you see what is the shape of this curve? It's inverted. And this is not like it's inverted yesterday or like 5 days ago. This has been inverted for now like about 18 months. And what economists have always seen in the future is the inversion of yield curve has never failed. I mean, it has been right 100%. And a recession comes into play in just 18 months of the yield curve inversion. So 18 months have happened. So are we looking for a recession? Well, I can't say that, but at least this is pointing towards it. Another scenario. Now, over here we saw the yield curve inversion. Now look at the short-term yields rising. So, if the government can anticipate a recession, can it go ahead and cut the interest rate so that it can stimulate the economy? No, because the yields are so high, the yields are expecting the government to hike the rate again from this point. And you know what happens if we keep on increasing the interest rate. The economy is already fragile, the housing market is already fragile, and what happens if we increase the interest rate? The mortgage payments goes up. There could be a housing default. There could be other corporate defaults. We already saw Silicon Valley Bank and Signature Bank going down. So it's not possible for the government to keep on increasing. So they might keep the interest where it is. And the other big problem for the US government right now is the inflation. And this actually is pointing out towards a higher inflation in the coming months. Because if there is higher inflation, there will be a need to increase the interest rate. So that's the catch-22 situation here. If you go back to the pandemic times, the yield curve was only 0.2%, which means everyone expected, okay, so this is like the era where we cannot increase the interest rate. Now, the short-term market view is we want the interest rate to increase, but the long term it says that the yield curve is inverted, which we might see a recession. So I would say the economy is in a really bad shape. And what is happening is oil prices, inflation, political drama, and now the Israel attack and everything is coming in between, and it's not helping the scenario a little bit. Now let's look at what the stock market says. The S&P has been on a superb run since the COVID-19, and people have made a huge people have made huge gains into the stock market, but the economists are predicting that if the yields breach 5.5% in 2024, and like the way we are going, it could be a big problem because we'll have to increase the interest rate. And if the inflation numbers tick up, which they have already started, the um, the government would be forced to increase the interest rate, and knowingly they would actually go and bankrupt many of the indebted companies and mostly banks. So, and and the recent data which was showing soft landing might not be a soft landing at all, and the moderate recession here is merely being delayed, but it cannot be avoided. In fact, the markets see 80% chance of the Fed keeping the interest rate at the same place. So we have a catch 22 situation. We have to wait and watch what will happen in the future. Will the yields come down? Will there be a better inflation number? If not, then all sorts of problems are indicating to a huge market correction. I would say a crash rather than a correction. Correction would be a normal word, which can happen in a bull market as well. But this is all pointing towards at least 40 to 50% downside in the S&P index and wipe out a huge chunk of investor wealth. Thank you for watching. If you like this video, please share, subscribe,